Hey there, everyone. Happy Tuesday, January 27th. I'm Dave Keller, and welcome to Chart This with Dave Keller, our daily market recap show. Great to be joining you here from a beautiful winter day here in Redmond, Washington. Hope you guys are staying warm, staying safe. Hope those of you in that big line of wintry goodness from Texas all the way up to New England are hanging in there. My daughter's actually en route, flying back from boarding school in Michigan to visit us here in Seattle and do some college audition stuff. And thankful that she is safely, with a couple of hiccups along the way, traveling okay. So if you're traveling, oh man, good luck. It's an adventure these days, getting around with the weather and everything going on. With that in mind, decent day for the markets. I've got the trumpet in the background. It is that's the case right there. So I didn't get it out of the case, but I did bring the case into my office, which tells you we are very close to that 7,000 level, but we haven't quite done it. The S&P stalled out just below 69.90 in the first 2 hours of trading. Didn't get above there through the remainder of the day. Finished kind of in the upper end of the range, but just below 7,000. So that big milestone of 7K remains elusive, but the trend overall remains quite strong. Today, we're back to kind of some old school 2025 kind of movements, with technology at the top of the leaderboard, with the NASDAQ outperforming the Dow. The NASDAQ was up, the Dow was down. Small caps lagged, kind of back to growth over value for one day only. Now, we'll see if that trend continues, because the general trend that we've been observed, that great rotation away from growth leadership into value, away from large into small, was a bit of a contrarian move relative to those larger shifts. I would argue those larger shifts still very much in play, but why don't we look at the charts and see what we can figure out here? As a reminder, we appreciate you watching the Daily Market Recap show here on our YouTube channel. Please take a moment and drop a question in the comments section of our YouTube channel. We'd love to hear from you and hope to answer one of your questions in our next mailbag episode on the show. Looking at the S&P 500 here, you can see, as I mentioned, right in the middle, the Dow was down to just above 49,000. The NASDAQ was up around 0.9%. The S&P 500 up 0.4% to close just below 69.79. We're very, very close to that 7,000 level. Not quite there, but very, very close. Certainly in the green light region of our traffic light pattern. We talked about the S&P 500, thinking about a strong phase, a weak phase, or a neutral phase. We've certainly in the last week or so gone from neutral back to pretty positive. And we have the charts to prove it. Mid caps were flat today. Small caps were down slightly, which again is kind of going against the general trend we've been observing here in January. It's been small caps really impressing to the upside today, pulling back a bit, but still in good shape. The volatility remains fairly low, with the VIX down around 16.4. That's a low volatility environment with the VIX below 20. So, keep in mind, low volatility conditions are good according to the options market. Looking at interest rates, we've got the Fed meeting, the first Fed meeting of 2026 happening this week, happening today and tomorrow. Tomorrow, we'll expect to get a decision from the Fed. Market pricing in essentially no real chance of any change in the target rate. Market pricing in a cut or two through the course of this year, but no real aggressive nature to what we're seeing in terms of expectations. Tomorrow's, announcements will be a lot less, most likely, about the, any change in the target rate, but it will be about, the language describing the Fed's evaluation, the Fed's assessment of monetary conditions, assessment of economic conditions, and trying to get a sense of the trajectory of potential rate cuts through the course of the first half of this year. But generally speaking, the market pricing in not much more. By the way, I had a great interview earlier today with Simeon Hyman, the chief strategist at ProShares, knowledgeable market strategist, some great insights for Fed Week about interest rates, about economic data, and the general strength he's observing in economic conditions, weaker dollar, higher rates, what all of those things could mean. So please keep an eye peeled for that. That should be out your way later this week. We'll try to get out to you when we can, for sure. Today, for example, though, rates moving slightly higher, the 10-year yield creeping up a little bit to 4.22, long bond yield just above 4.8%, short end of the curve moving down a little bit. You can see the TLT, which is a treasury bond ETF, generally went lower today, as did the US dollar. So you're sort of seeing a rotation away from the dollar, away from the bond markets into risk assets, and certainly non-US markets continuing to look pretty good, particularly with that weaker dollar. That was one of the big tailwinds to the non-US equity market picture in 2025. That trend appears to be continuing here so far in 2026, with the dollar weakening pretty aggressively here this week to kick off, sort of continue that weakness that we observed. Gold and silver continuing to push higher. Gold closing above $5,000 an ounce for the first time in history this week. Just not even pausing, like it wasn't even there. GLD continuing to push higher, about 2.5%. The SLV, which is a silver ETF, up another 3.3%. Generally low correlation between gold and silver and equities. So don't think that that is a bad sign for equities necessarily. Does it imply that people are flocking heavily to the expected safety, or the general safety that is implied by precious metals? Certainly seems to be the case by the fact that the price continues to go higher. Crude oil price is moving higher as well, and that weaker dollar really provides opportunity for gold, silver, crude oil, other commodities to appreciate in US dollar terms. That's generally what we've seen here so far in the new year. Bitcoin having a choppy 24 hours, but did rotate higher here in the last 6 hours or so. Currently trading just above 89,000. That's up slightly. Ether prices back above 3,000, which is encouraging. We've been below 3,000 here for a little bit. So maybe the mojo coming back to some of the crypto charts. We'll see as we continue to follow the evidence here in through the course of the week. Sector-wise, growthy of the growth, technology at the top of the list, up 1.4%, followed very, very closely by utilities, which was up about the same, 1.3%. Energy up 0.9%. Those are your top three performers. Note that the fourth best sector was consumer staples. The sixth best sector was consumer discretionary. So that offense to defense ratio continuing to favor defense over offense, implying there's a little bit of an issue here with consumer discretionary not leading the way higher in January. It's more the defensive side of the consumer space, consumer staples doing a little bit better here. And that is one of those general risk measures I tend to keep an eye on, something to think about. The strength in utilities, I don't know how much I would read into that. That was one of the mailbag questions I think we had on Friday's episode about utilities being more of a defensive sector or more offense. And it really has been tracking technology pretty closely. Obviously, there's a big rotation or big investment by a lot of big technology companies in AI infrastructure, and that is requiring a ton of power, and that's where utilities are coming in and moving higher so far. On the downside, 4 of the S&P sectors finished in the red. Healthcare, the worst performer, down 1.7%. Financials, which struggled with earnings last week and just continuing to struggle. I did grab the chart of the XLF along with some other charts to talk a little bit about the financial sector here on today's episode. Communication services down about 0.75% as well. Here we go. All right, looking at the breadth data, advancers versus decliners, favoring advancers, but it depends on where you look. On the New York Stock Exchange, 53% up, 45% down. On the S&P 500, kind of flipped, 53% up, 53% down, 47% up. So depending on what universe you're looking at, what slice of the equity space you're looking at, bit of a different picture, but none of these are significant readings one way or the other. They're all kind of colored neutral, orangish yellow, and that's pretty much what this is telling you. The breadth generally has been pretty positive here recently. Going back to the fourth quarter, sort of stalling out here today. Looking at the Magnificent Seven and friends, you can see Amazon leading the way higher, even though the consumer discretionary sector, not great today, but Amazon having a good day, up 2.6%. Broadcom, up 2.4%. Microsoft, up 2.2%. So 3 of the Magnificent Seven stocks actually doing quite well here. As a friendly reminder in terms of Mag 7 earnings, Microsoft, Meta, Tesla all slated tomorrow. On Wednesday, on Thursday, expect Apple's earnings. And so 4 out of the Magnificent Seven and friends, as I call it, all reporting earnings this week. Tesla, by the way, down 1% going into their earnings report. Netflix, which reported earnings earlier in the month, slightly lower. Meta basically flat for the day. All right, let's go to the market carpet. As a reminder, we appreciate your questions. And thanks so much for dropping them in here. Before we get to the market carpet, something's weighing on me, and I just wanted to share it with you. I heard horrible news just a little while ago. Jeff Hughes, one of my good friends and a fantastic strategist in his own right, based in Minneapolis, told me the bad news that Doug Ramsey, who's the chief investment officer at Luthold Group in Minneapolis, passed away last week. I didn't know that. Doug Ramsey is a fellow Buckeye, a CFA and CMT dual charter holder, a fantastic market strategist. Ran a lot of the investment portfolios and the research operation at Luthold after Steve Luthold stepped away years ago before he passed away a number of years ago. Doug Ramsey stepped into some huge shoes and did a fantastic job. He talked about the major trend index, a lot of their very disciplined way of thinking about all the evidence from a technical perspective, doing a lot of bottom-up work, thinking about stock movements and breadth conditions, but then also comparing that to a really well-documented top-down process as well. Doug was also a genuinely warm and lovely human being. I interviewed him a number of times on Stock Charts TV and also for my podcast last year, and I was actually planning to reach out to him to get him back on the show. He passed away suddenly, and heart goes out to him and his family and his friends because he was one of the good guys. That just sucks. I won't lie to you. So rest in peace, Doug. All right. With that in mind, sorry for that horrible transition, but it was on the back of my mind. I didn't have a good way to share that one with you, but I appreciate you listening. Let's go to the market carpet, shall we, and distract ourselves a bit with some of the pretty colors here on the chart. So market carpet, of course, our plan when we look at this visualization is to think about what happened today, but not have that be the end of our analysis, right? We're going to look at what happened today and then think about how that relates to the big picture, right? So, one day's movement doesn't make a trend, but thinking what this does in terms of additional incremental evidence to understand the larger picture is what I think is so important. If you look at the heat map today, very mixed, right? And there's some clusters of where there was some pretty decent movements. Some ones to highlight if you missed them in the technology sector, not everything. So you've got a number of names that are pretty bright red here today. But besides Microsoft, Broadcom, NVIDIA, and Apple, which are the four largest weights in the S&P 500, look at all the semiconductor names: Micron, Lam Research, KLAC, Applied Materials, even Intel all had pretty good up days. LRCX up about 7%. So some nice movement there. Some of the like hard drive names like Seagate, Western Dig, both having pretty good days as well. So it was really sort of a stock picking exercise in the technology sector, which has kind of been a theme, right? And this is something we talked about in our 2026 market outlook, which we shared earlier this month for our premium members. Big story at the end of last year, we think, which is going to be a key area to focus on, is this continued rotation. And particularly within sectors like technology, it's not just we're past the, I think, buy everything AI related kind of trade. This is more of a let's figure out which companies are actually able to grow using AI. Let's figure out which companies are going to leverage AI to do whatever they do better. And that gets into like consumer and industrial names that are actually going to be using those AI capabilities. Energy that supports the infrastructure build out. And so forth. But it's not just the theme. It's now let's focus on which stocks present good opportunities. And I think that's a fundamental exercise. I also think that's a technical exercise, right? Looking at where the charts are emerging in a position of strength. Where else are we seeing some strong green on here? Definitely not in communication services, but we are seeing Amazon. Although outside of Amazon, very few in the consumer discretionary sector even finished in the green, although the automakers, Ford and GM, had a pretty decent day. Sort of moving up while Tesla moved lower. In the industrial sector, that aerospace defense group is doing pretty well. I think Raytheon was an earnings name today, but you've got RTX pressing new all-time highs, NOC, Northrop Grumman, NOC, and others having some pretty good up days. Lockheed Martin made a new all-time closing high today as well. Elsewhere, I would say the energy sector, the utility sector, obviously doing pretty well. And within consumer staples, I just keep coming back to charts like PM that are just really starting to improve. Tyson Foods made a new 52-week high today. That's in the food products group, which is not known as the juice. That's not your traditional offense, but looking pretty good. So interesting pockets all around the heat map of names looking pretty interesting today. What did not do particularly well? Well, obviously, the other side of the coin in technology, look at all the names that are bright red. Charts like Intuit come to mind. I mean, there's some of the charts in the sector that have not looked good for a while. ServiceNow has been in a primary downtrend for quite some time. A number of these had a bit of a bounce this week, but continuing to rotate lower. What else? Not looking great. The financial sector, boy, continues to be on the list. Financials looked so good going into earnings season. I mean, generally speaking, pretty good charts. And we talked about some divergences from December into January. And unfortunately, it feels like more and more some of those divergences were pretty prescient in terms of recognizing some internal weakness on some of those charts. And we're seeing some of those rotate lower. Out of the top 10 names, I mean, a lot of names, not deep red, but certainly lighter red, implying that they're not participating. And then within healthcare, and then the final comment I would make here is that healthcare was one of the worst sectors today, but it wasn't everything, right? And this is, again, more of a stock picking exercise, similar to technology. There are days when like the whole sector is red. This was not one of those days. This is a day when there are a number of charts that did not go lower, actually pushed higher a bit today. So don't just write off a whole sector because it was down today. Think about the opportunities within it. That's where the heat map really can be quite helpful. All right, let's finish off looking at some charts together, shall we? The S&P 500, again, not quite making it to 7,000, but it almost seems like it's happening here at some point. I brought the case up earlier today, and my wife caught me and was like, "Are you taking it? Is it going above 7,000?" I was like, "It's not quite yet, but maybe today. We'll see." So I have it ready. I haven't gotten it out yet. I haven't played in a while, so we'll see what happens. You may regret me promising that I would play the trumpet on the show, but I'll do it. I'll do it the day we close above the S&P. I'll get it out there and give you something to listen to for a bit. Overall, again, back above the 50-day, which is good. That was after the gap lower last week around the Davos forum, gapping higher or moving higher to finish the week. This week, really just opening strong and remaining strong Monday into Tuesday. A lot of earnings Wednesday and Thursday, including 4 of the Magnificent 7 stocks. So certainly plenty of things that could propel the S&P over 7K. Also, plenty of things, of course, that could cause the S&P to stall out and not get above there just yet. We'll have to wait and see. The momentum really needs to improve, though. I think that's one of the things that we've been noting is on the chart of the S&P. The momentum really hasn't been good since October. In November, December, and January, which is as we've been pressing these new highs, note how the RSI has not really gotten much above 60. So this is more of a market, with less strong momentum. There's not really this big, obvious accumulation happening on indicators like RSI, and I think that's noteworthy. I really enjoyed interviewing Simeon Hyman of ProShares earlier today. Again, that episode, keep your eyes peeled for that one. Should be in the next day or two. But I will tell you that the weaker dollar, a big story here in the last week. Really, in the moment you start the clock on the Davos World Economic Forum, that's when the dollar starts to weaken. A lot of people attributing this to a lack of confidence in the U.S. and trade deals being signed away from the U.S. And that implies that there's capital is going elsewhere. A number of things that can cause the dollar to weaken. I certainly think that's a part of it. I would also say the weaker dollar. What does that mean? It can mean a lot of things, but I think one thing it definitely is you're seeing here this week and last week is the weaker dollar basically opens the door for crude oil prices to go up, which they are. Opens the door for gold prices and silver prices to continue higher. We're seeing gold make a new all-time closing high yet again today. We're seeing crude oil potentially make a new 3-month high here today. So improvement. The more the dollar weakens, the more that commodities generally can be assumed to go higher. All right, let's talk about stocks to finish this off here. NVIDIA is not one of those earnings names. NVIDIA actually reports kind of off cycle, so they won't report for another month. They're late February. However, still monitoring what I would say is potentially kind of a complex head and shoulders topping pattern, which is a peak surrounded by lower peaks on the left, lower peaks on the right. It's looking more and more symmetrical between these two halves, but none of that matters until and unless we break below a neckline connecting the major lows, which means, NVIDIA below 175 is pretty ugly as a major topping pattern. Continuing below the 200-day moving average would be the nail in the coffin there, but it hasn't happened yet. NVIDIA is kind of mid-range of where it's been for the last couple months. So we'll see. We'll see if there's a short-term breakout. NVIDIA above 195 opens the door to retest the previous highs, and all of a sudden looks a lot less like a complex head and shoulders top. So remains to be seen. We'll see if there's some sort of sympathy move with some of the big technology names reporting earnings this week. Amazon having a pretty good day. We can see the chart almost similar to NVIDIA, right? In terms of that complex head and shoulders type of pattern. But you can see that now all of a sudden it's looking a lot less symmetrical, right? The right side all of a sudden starting to lift up. We're making a higher swing high, a higher low. And now we're breaking up yet again. So, overall, the momentum is strong. The price is improving as these pullbacks are getting higher and higher. That's more of a constructive pattern, despite the fact that consumer discretionary as a sector has not done particularly well. Now, talking about weakness in a sector, the financial sector has been one of the big disappointments so far in January. This is a sector that's doing remarkably well in Q4, outperformed a lot of the big banks and even the regional banks looking strong going into earnings season. But now we're starting to see the XLF rotate lower. This is the XLF in the top panel, by the way. We can see the new all-time high in early January. But over the last couple of weeks, we've been rotating lower, and the sector, as a result, has started to underperform. Now, when I think of the financial sector, I think of generally, and again, I'm generalizing, three of the ETFs I keep an eye on are the S&P Spider ETFs, the bank ETF, which is KBE, the regional banking ETF, KRE, and then the insurance ETF, KIE. Those are kind of the three that I keep an eye on besides just the sector as a whole. So the XLF breaking below the 50-day moving average looking kind of weak. But here's the bank ETF, the KBE, actually rotating, kind of trending higher highs and higher lows, well above the 50-day. The same for the regional banking ETF. So what gives? How is the financial sector rotating lower while these, bank and regional bank ETFs are going higher? Well, insurance has not been a great part of the story. Insurance companies actually peaked in December, and the KIE has actually been trending lower through the month of January. But insurance is not a huge weight. It's one of the more defensive areas of the financial sector. Tends to move differently than banks and regional banks because their businesses are quite different. So I don't think the weakness in insurance is enough. So what causes it? It comes down to the weightings and which stocks are the biggest names. The biggest weight in the XLF is arguably not even a bank. It's Berkshire Hathaway, which is a weird industrial conglomerate that includes some, in reinsurance companies and financial things, but it's kind of a weird name. And I mean, arguably Berkshire is kind of its own sector. It's kind of its own thing. It's one that does not fit particularly well evenly into one sector. So the biggest weight in the XLF is Berkshire Hathaway. And it's not a small weight, by the way. It's actually a decent overweight. I was looking at this earlier. Let's see, Berkshire Hathaway currently almost 12% of the financial ETF, the XLF. JP Morgan is second, about 11% of the weight. And then you have Visa and MasterCard, which together are about 12%. And then you're down to around 4.5% and lower for the rest of them. So Berkshire is a huge weight, even though it's not really a traditional financial firm as we would think of it, more of a conglomerate, more of a holding company. But look at what's happened in January, right? So that the biggest weight is going down another 1.8%, testing key support. I would say from a technical perspective, kind of right at that point where you want that to hold, right as we're overbought. We break below like 475, and this becomes a pretty ugly chart, even uglier than it's been. Here's JP Morgan, which even though the bank ETF has been going up, JPM is one of those banks that did not do well coming out of earnings a couple weeks ago. They reported 2 weeks ago. And we can see the the uptrend right into the earnings release, and then it just rotates lower. And now we're sort of in a bit of a free fall here. Now, similar to what we saw with Berkshire Hathaway, testing key support. 290 is where the 200-day moving average is. That's also all these lows going back to September, all around 290. So breaking below that level would be a very negative sign. MasterCard, Visa and MasterCard are number 3 and number 4. I'm highlighting MasterCard here. Not only did it fail to break out, it actually rotated lower. So a failed breakout is where you have a clear rotation above the previous resistance. It's making higher highs and higher lows, but then instead of continuing higher, it rotates lower. So it's a breakout that just fails to continue. So I call that a failed breakout. It's a sign of a, sort of a head fake, something that looked pretty encouraging. We talked about the chart in December because it was breaking back above the 200. It looked like a great opportunity, higher lows, but then it all failed, right? And we broke below the 50-day. The momentum got weaker. The relative strength deteriorates. I did my most recent show on Stock Charts TV just earlier today, focusing on MasterCard and other charts that feature failed breakouts. So check that out if you haven't seen it yet. It should be posted now, and if not, very, very soon on the Stock Charts TV YouTube channel. But I would note that we just recently broke below the 50% retracement, which puts a downside target around 512 to complete that Fibonacci framework. So financials are struggling. Again, it's not because the KBE or KRE are going down. It's because the biggest weights in the XLF are kind of struggling here recently. So what's actually going up? Well, there are some good things happening on charts like General Motors. General Motors and Ford, two of the names kind of up while the rest of consumer discretionary was generally lower. We can see GM up about 9% today, making new all-time highs. This is an earnings name today, if I remember right, although it's not showing up here. I think it was a name today. And a nice gap higher. This after pulling back to the 50-day moving average. Great setup for this rotation higher. We want to see continued strength, continued momentum, but a nice upside swing. On the downside, you have charts like United Health. Again, looked very encouraging a couple days ago, right? Pushing 360 and then gapping lower. And I often get questions. We've got one more chart to show you, but I often get questions on charts like United Healthcare. And I'll jump ahead of your question. I often get a question when I show a chart like this saying like, well, United Health was a good chart and then it broke down. So what happened? Does technical analysis not work? I mean, nothing works 100% of the time. I wish it did. I wish I could share with you, here are the indicators that always work and they never don't work. And unfortunately, I see other YouTube channels pitching that general idea. If you do this, it's like a 90% hit rate or some ridiculous fake number. And I mean, it's not sustainable. That's not really generally true. And it's honestly not even what you want to be looking for. The reality is part of investing in any individual equity is you're taking on risk. You're taking on company risk. You're taking on earnings risk, taking on volatility risk. You're taking on just the general equity risk, right? If you want no risk in your portfolio, buy a bunch of treasury bonds, right? And then go sleep and nap and don't worry about it. But if you want better returns than a treasury bond, you're taking on additional risk for the opportunity for greater return, which means generally equities do better than cash. But it also means sometimes your equities don't go up. And so it's not about being right all the time. It's betting on things that have a high probability, but recognizing that it's also possible it just doesn't work. So cut your losses quickly and move on to the next opportunity. UNH is one of those charts that looked pretty encouraging here with a break above the 200-day moving average just in the last couple of days, getting to a new swing high just briefly. But today's earnings miss kind of makes you question that as a good uptrend. Maybe want to reset and see where it finds some stability. At the risk of finishing with a somewhat depressing gap lower, let's finish with charts going up. Amphenol, APH, is one of the technology stocks doing quite well. Remember, in the technology sector, I would argue it's not about the sector. It's not about the theme. It's about individual stocks and groups. Focus on the charts to help point you in the direction of things that are still working. Use charts to recognize when things are no longer working. Analyze the chart well, do what the chart is telling you. Let the chart tell you when it deserves a spot in your portfolio, and then be a good listener when the chart tells you it no longer deserves a place in your portfolio as well. That'll do it for today. Thanks so much for joining me here on Chart This with Dave Keller. Hope you found this helpful. Hope it helped you make sense of the markets today and gave you some ideas about how you can make better decisions tomorrow. Please take a moment and drop a question. Any question is fair game. We'd love to hear from you. Any feedback on the show, always welcome as well. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Have a good night, folks.